Is your investment earning quietly reducing? The complete game of compounding cost. At 11 o'clock at night, Rohit opened his mutual fund statement. The market news was happy, the Sensex was high, and everywhere there were talks of wealth creation. But there was no happiness in his statement. Even after a 5-year SIP, the amount did not look as big as the calculator had once shown in dreams. At first he felt perhaps the market had deceived him. Then he looked at the returns. The fund wasn't bad. The real question had now become even scarier. If the market was fine, the SEP was also regular, then why did the money grow less than expected? The answer was hidden not in the bold line of the statement, but in small letters. From here begins the quietest but most expensive story of investment. This is a story not of loss, but of that earning which gets cut even before it becomes visible. Most investors consider compounding a friend. Money grows, then a return comes on the grown money as well, and gradually a small amount becomes big. But C Bogle showed the other face of this very story. He said, compounding does not work only for you, it works for the cost as well. Hearing this for the first time feels strange. Expense is just a small percentage, then how can it become such a big threat? Because in investment, cost is not cut just once. It keeps taking its share from your corpus every year, every day, in every growth cycle. You think the fund is giving 12%. But if cost, fee, tax and wrong behavior combine to make the return 10.5%, the story changes. In the beginning, the difference looks small. A 1% cost on 10 lakh rupees feels like just 10,000 rupees. But the real game does not open in the first year. 20 years later, that same 1% can turn into a difference of lakhs of rupees. Because you did not just pay a fee, you also lost the future growth that would have been earned on that fee. This is compounding cost. It does not feel like an out-of-pocket expense because the money does not go directly from your bank account. It is deducted from your future corpus. Therefore, the pain is not felt today, but the impact comes forward at the time of retirement, a child's education, or buying a house. Now imagine, two friends start investing on the same day. Both put in 10,000 rupees every month. Both get almost the same gross return from the market. The first friend's fund is low cost. The second's fund is expensive. For 10 years, both do not understand the difference much. But after 25 years, the first corpus looks much bigger. The second friend is surprised because he too had put in the same amount of money. His mistake was not leaving the investment. The mistake was ignoring that slow leakage which was weakening his compounding every year. First of all comes the story of the expense ratio. To run a mutual fund, the fund house charges for management, research, operations and distribution. This expense is deducted from the assets of the fund in the form of the total expense ratio, meaning TER. The investor does not get a separate bill, which is why many people do not even feel it. In a regular plan, distributor commission may also be included. In a direct plan, that same commission is not there, which is why its expense ratio is usually lower. Here is a quiet twist. Many investors think that the advisor is suggesting funds for free, but the commission is added somewhere or the other to the cost of the fund. This means a regular plan is not always wrong. If the advisor is providing real planning, behavior control and risk management, there can be value. But if in exchange for just telling a fund name, a high cost is being charged for a long time, the investor should ask what is being received in return. Then comes the story of the active fund. An active fund manager tries to bring a better return than the market, which is why the research team and trading cost can be higher. If the fund is really giving more return than the benchmark, the higher cost can look justified. But the problem arises when the extra return does not last. Many times the past performance of the fund looks spectacular, but that is no guarantee of the future. Yet, the cost remains certain in the future. It is necessary for the investor to understand this very contradiction. Return is uncertain, but the fee is almost certain. And in compounding, a certain cost is very powerful. C Bogle talked about low-cost index funds for this very reason. His logic was simple: if the market return can be achieved, why pay an unnecessary cost? An index fund does not depend on a star manager. It tracks a benchmark, which is why its operating cost is usually lower than an active fund. But here too there is a trap. Low cost does not mean blind investment. It is also necessary to look at factors like tracking error, liquidity, and fund size. Now the story does not remain limited only to the fund fee. The investor's own behavior can also create a compounding cost. Selling in panic every time, then buying back seeing the recovery, this is not just an emotional decision. It also creates a transaction cost and a tax cost. Brokerage, STT, Exchange charges, bid-ask spread, and short-term tax all combine to make small tears. The portfolio looks fine from the outside, but keeps becoming weak from the inside. The most shocking thing is that many investors harm themselves more than the fund does. The fund gives 12%, the investor behavior gets stuck at 8%. Because he stops the SIP during a downturn. He buys a new fund during a boom. He switches after watching the news. Every action brings a cost. Here is another hidden cost, cash drag. The investor thinks he will invest when the market falls, therefore the money keeps lying in the savings account. Whether the market comes down or not, that money is not compounding in a productive asset. Waiting also sometimes becomes a cost. Then the layer of tax comes. In equity mutual funds, long-term and short-term tax rules are different. The rules for debt funds can be different. Frequent switching can trigger a tax event. The investor thinks he chose a smarter fund, but tax cut a portion of the performance. Exit load also looks small many times. Hearing 1% sounds minor, but if switching is happening every year, this habit can be expensive. Now imagine water is filling in a bucket. The return is water, the sip is the tap, and the costs are small holes made at the bottom of the bucket. When the bucket is small, the leak is not visible. But as the bucket becomes big, every percentage point means big money. This is the reason why even investors with high income miss out on wealth. The problem is not of saving, it is of leakage. Another myth is that an expensive fund is more premium, as if an expensive thing will be better. In investment, this logic does not always work. Sometimes an expensive fund is just expensive. Being better has to be proven by it in the net return, that too over a long time. If a fund takes 1.5% cost and gives 2% more than the benchmark, that is a different matter. But if it runs equal, the investor is left behind. Mutual fund returns are visible after the NAV, meaning the expense ratio has already been adjusted. Even then, the investor should understand the cost, because the comparison becomes clear from here. One fund shows 13%, another 12.5%. If the risk, style and consistency are different, then a decision made just by looking at the return will be incomplete. The expense ratio has to be looked at along with the benchmark, category average, risk, and time horizon. A single number does not tell the story, but it does not hide the story either. The biggest shock of compounding cost comes in retirement planning. When the goal is far away, a small cost looks harmless. But in 30 years of investing, a 1% annual difference can change the final corpus significantly. This very difference can stand between a comfortable retirement and a compromised retirement. The same happens in a child's education planning. Parents start a SIP, but they do not connect the fund cost, inflation and tax together. Then at the admission counter it is discovered that the corpus was indeed created, but not as much as was needed. The story becomes painful there. Now the question comes, is choosing just the cheapest fund the solution? No, and this is the place that cautions the most. If a fund is low cost but poorly managed, illiquid or the wrong asset class for your goal, even a low cost will not save you. Keeping the cost low is necessary, but the correct asset allocation is even more necessary. The balance of equity, debt, gold or cash depends on the goal and risk. An investor who can keep 25 years for retirement will have a different strategy. One who needs a house down payment in 2 years will have a different one. Understanding the cost does not mean being afraid of every fee. It means knowing which fee is giving value and which one is just eating up wealth. An advisor fee is also not bad if the advisor saves you from panic selling, shows the insurance gap, and makes a goal-based plan. But if the advice is limited only to selling a product, the investor will have to understand both the cost and the conflict. This is where the real test of trust happens. Digital investing has made entry easy, but it has also made overtrading easy. Buy in one tap, sell in one tap, and every tap can add an emotional cost. Apps show you charts, send notifications, tell you trending funds. But compounding needs patience, not noise. The most dangerous moment is when the investor gets bored. He feels something should be done, whereas sometimes the most profitable action is to do nothing. This is easy to hear, difficult to do, because the market tells a story every day and cost sits quietly behind every decision. Bogle's lesson was powerful because he did not make the investor a hero. He simplified the system so that even an ordinary investor could win. His message was, do not empty your pocket in the attempt to beat the market. Keep a large part of the market return with yourself. This point is even more necessary for Indian investors. Because the SIP culture has grown rapidly but cost awareness is still not that strong. People ask which fund is the best, But fewer people ask, what is the total cost of holding this fund? People ask, how much return came last year? But fewer people ask, was this return really better after risk and expense? From here, mature investing begins. When the investor starts looking beyond the shining return table to understand the net outcome. Net outcome means how much you have left in the end. Gross return is the headline, net return is your real life. For a family, this very difference can determine whether a child chooses a college of choice or compromises. This same difference can be seen in a home loan finishing quickly or dragging on. The biggest twist of the story is that compounding cost is not a villain, it is a mirror. It shows that in investment, every small choice becomes big in the future. You choose the fund, choose the plan, choose the advisor, choose the tax timing, and above all, choose the behavior. Every choice gets recorded in compounding. If the cost is unnecessary, it cuts wealth. If the cost is buying meaningful advice or discipline, it can be a part of the investment. Therefore, the real question is not how to make the cost zero. The real question is whether you are getting real value in exchange for every cost. When the investor starts asking this question, he moves out of just return chasing. He enters the deeper game of wealth building. Compounding can make you rich, but compounding cost can reduce your speed. Both walk on the same path, the difference is of direction. In the end, the story returns again to Rohit's statement. This time he did not look just at the return, he looked at the expense ratio, direct plan, turnover, and his switching habit. He understood that money was not stolen by the market. Money was lost in those small decisions which he never even considered a decision. And perhaps this is the quietest truth of investing. Wealth is not created just from the return that the market gives, but is created from that portion which you save along the way.
This video has taught you something new. Or if you feel this information should reach more people, don't forget to like and share the video. Your small share can become valuable and useful information for someone else. If you have any questions related to this topic, or if you would like to share your opinion with us, be sure to write in the comment box. We read every question and suggestion from you, because your feedback inspires us to create better content. And if you want to keep receiving such interesting and reliable information about business, the economy, and the world in the future, then don't forget to subscribe to our channel GRT Business and also press the bell icon so that you get notifications of every new video directly. At GRT Business, we always strive to provide you with accurate, balanced, and reliable information. Our news and analysis are prepared based on information obtained from various news agencies, public sources, and public opinion. We make every effort to verify and validate each fact as much as possible, but in case of any possible error or dispute, the responsibility lies with the respective sources. Our only aim is to present you with a correct and trustworthy perspective so that you can understand any topic better.